Hi everyone, welcome back. Now in this lecture, we're going to start solving questions from Ind AS 116, which is leases. Let's start with illustration number 30. I'm intentionally skipping all illustrations in the beginning and starting with illustration 30, and then we will actually go back and solve earlier illustrations. Entity ABC, which is the lessee, has entered into a 3-year lease of equipment. The asset that is being leased is an equipment, and ABC is the lessee and is entering into a 3-year lease of equipment. There are two parties in a lease agreement. One is the lessee and the other is the lessor. Lessor is the entity which is giving the asset on lease. Lessor is the entity that is giving the asset on lease, and lessee is the entity which is taking the asset on lease. So in this case, ABC, which is lessee, is basically obtaining the asset on lease, and ABC will be using it for its purpose for the next 3 years. Entity ABC agrees to make the following annual payments at the end of each year. Now, lessee is required to make payments to the lessor, and what the question is saying is these are payments that are going to be made annually and they are going to be made at the end of each year. Now, I'm emphasizing on the word end of each year because the timing is relevant, because we are going to use discounting. We are going to discount the lease payments, and hence when we actually make the payment is of relevance. Whether you make a payment at the beginning of the year or whether you make a payment at the end of the year is going to be relevant in the context of discounting. In this example, we're making payments at the end of each year. So since it is a 3-year lease, they've given us the rentals that we're going to make in year 1, year 2, and year 3. The payments that we're going to make in year 1 is 20,000, year 2 is 30,000, and year 3 is 50,000. So ABC is going to pay to the lessor 20, 30, and 50,000 in year 1, 2, and 3 respectively. For simplicity purposes, there are no other elements to lease payments like purchase options, lease incentives from lessor, or initial direct costs. We'll actually look at these examples further in detail, but I'm actually at least explaining what they're actually meaning. Let us say at the end of lease period, what the question is clarifying is there is no purchase option. At the end of the 3-year lease period, ABC does not have an option to purchase the asset. That is what the question is actually clarifying. There are no other elements to lease payments like purchase options. All right, because if such an option would have existed, then ABC would have had to make an additional payment for purchasing the asset. If such an option would have existed, ABC would have had to make an additional payment for purchase of asset, and the question is clarifying is that there are no such purchase options or lease incentives or initial direct costs. What are lease incentives and what are initial direct costs? We'll actually look at it at a later point, but the question is saying that there are no other elements to lease payments. Assume a discount rate of 12%, which is ABC's incremental borrowing rate, because the interest rate implicit in lease cannot be readily determined. All right, I had mentioned that we're going to discount the lease payments. They've given the discount rate of 12%. They've written something in the brackets. We'll actually come to the understanding of that as we proceed through the solution. Entity ABC depreciates the ROU asset on a straight line basis over the lease term. How would entity ABC account for the said lease under Ind AS 116? Now, this is accounting in the books of lessee. All right, the heading also said lessee accounting. This is accounting in the books of ABC Limited. Now, there are two aspects to accounting. One, there's something called initial recognition, which is how do you account for the lease on the date of commencement of lease. Today, the lease has commenced. So how would you actually account for this lease? That is regarded as initial recognition. What are the journal entries that you will record on commencement of lease in the books of lessee? That is initial recognition. The second is called as subsequent recognition or subsequent measurement. Subsequent recognition or subsequent measurement. What subsequent measurement basically implies is how are the assets or liabilities going to be accounted on each balance sheet date. Remember, the lease is for a period of 3 years. So there are going to be 3 balance sheets that you will have to prepare, and the subsequent measurement basically represents how is this lease going to be accounted in the income statement and in the balance sheet, in the P&L and in the balance sheet in each of the 3 years. How are you going to account for the lease in the income statement and in the balance sheet in each of the 3 years? That is referred to as subsequent recognition or subsequent measurement. Let's start by actually jotting down the solution. So step one will be initial recognition. Step one is basically initial recognition. The meaning of initial recognition is what are the journal entries on the date of commencement of lease. Initial recognition on date of commencement of lease. The lease has commenced today. The lease has begun today. So what are the journal entries on the date of commencement? Now, what Ind AS 116 states is, on the date of commencement of lease, lessee is required to recognize an asset in its books called the right of use asset and a corresponding liability called the lease liability. Ind AS 116 states that lessee in its books of accounts is required to recognize an asset named right of use asset and a corresponding liability named lease liability. All right, so the journal entry is in the books of lessee is going to be ROU asset, right of use asset. The asset is referred to as ROU or right of use asset, and we correspondingly recognize lease liability. All right, so the journal entry is ROU asset debit to lease liability. ROU asset debit to lease liability. Now let us quickly understand, why does the Ind AS actually require us to record right of use asset and lease liability? Now, what Ind AS is trying to state is, you have actually taken an asset on lease. The lessee has actually taken an asset on lease, and therefore the lessee has a right to use the asset for the next 3 years. The lessee has got the right to use a particular equipment for the next 3 years. That right to use the equipment is an asset for the lessee. If I have a right to use a particular equipment, that is an asset for lessee, and that is the reason Ind AS 116 states that lessees have to recognize a right of use asset. Lessees are required to recognize the right of use asset because they have a right to use this equipment for the next 3 years. Hence, that right is an asset which is required to be reflected on the balance sheet. Correspondingly, the lessee has an obligation to make payments. The lessee has an obligation to make a payment of 20, 30, and 50,000, and therefore the Ind AS also requires us to recognize a lease liability on the date of commencement of lease. Now the question is, at what value are we going to recognize ROU asset and lease liability? What value are we going to recognize this ROU asset and lease liability? We are going to recognize it at present value of the expected lease payments. We are going to recognize the ROU asset and lease liability at the present value of the lease payments expected to be made in future. All right, so we are going to recognize ROU and lease liability at the present value of the lease payments that are expected to be made. So now let's actually calculate the present value of the expected lease payments. So that is our step 2, calculating the PV of lease payments. Now remember, this lease was a 3-year lease, so I'm plotting down cash flows for 3 years. All right, and we're plotting down cash flows for a period of 3 years. The cash flows were 20,000, 30,000, and 50,000. Let's quickly check if I remember the cash flows rightly. It was 20, 30, and 50,000 for each of the 3 years. The discount rate was given as 12%. All right. In brackets, they actually mentioned something about the discount rate. What is the discount rate? What was that? We'll actually come to it in a minute. Then we plot down the present value factor at 12%. The question gave the discount rate as 12%, right? So let's plot down the discount factors. The first year discount factor is 1 divided by 1.12, which is 0.8929. The second year will be 1 divided by 1.12 the whole square, which is equal to 0.7972. And the third year is going to be 1 divided by 1.12 the whole cube, which is equal to 0.7118. All right, so we have calculated the present value factors as 1 divided by 1.12, 1 divided by 1.12 the whole square, and 1 divided by 1.12 the whole cube. We then have discounted cash flows, which is equal to 20,000 multiplied by 0.8929, that is 17,858. 30,000 multiplied by 0.7972, which is equal to 23,916. And the last year is 50,000 multiplied by 0.7118, which is equal to 35,590. The sum total of this discounted cash flow is nothing but the present value of the lease payments. 17,858 plus 23,916 plus 35,590 is equal to 77,364. The present value of the lease payments expected to be made is 77,364. The present value of the lease payments expected to be made is 77,364. Therefore, in the lessee's books, ROU asset and lease liability will be recognized at 77,364. All right. On the date of commencement of lease, the lease commenced today. I'm calculating the present value of the lease payments expected to be made standing today, and that is equal to 77,364. And I am going to recognize right of use asset and lease liability to the tune of 77,364. So it is going to be right of use asset debit 77,364 to lease liability 77,364. All right, with this, we are done with the initial recognition in the books of lessee. On day one, when lease commences, we recognize a right of use asset and a corresponding lease liability. All right, right of use asset and a corresponding lease liability. At what value do we recognize? We recognize it at present value of the lease payments that are expected to be made. Now let's talk a little about the discount rate. All right, the question gave the discount rate as 12%. Now, Ind AS 116 states that the discount rate that is supposed to be used should be the interest rate implicit in lease. The discount rate that is supposed to be used should be the interest rate implicit in lease. If the interest rate implicit in lease is not available, then you can use the lessee's incremental borrowing rate. If the interest rate implicit in lease is not available, then we can use the lessee's incremental borrowing rate. All right. So first preference, interest rate implicit in lease. The second preference is lessee's incremental borrowing rate. Now, if you actually read through the question, it mentioned that discount rate of 12% is ABC's incremental borrowing rate because the interest rate implicit in lease cannot be readily determined. All right. Because we were not able to determine the interest rate implicit in lease, we used the lessee's incremental borrowing rate. What is interest rate implicit in lease? That we will actually learn in the context of lessor. We will learn that in the context of lessor. Now let's actually look at ABC's incremental borrowing rate. What that incremental borrowing rate basically means is if ABC entity goes to a bank and requests for a borrowing, if ABC goes to a bank and requests for a borrowing, 12% is the interest rate that the bank will actually charge from ABC. 12% basically represents the interest rate that a bank will actually be charging from ABC. That is referred to as ABC's borrowing rate or incremental borrowing rate. So 12% basically represents the borrowing rate for ABC from a particular bank. All right, so we use that as the discount rate to arrive at the present value of the expected lease payments. With that, we are done with the initial recognition. Now let's move on to subsequent recognition. I'm plotting it as step number 3, which is subsequent recognition or subsequent measurement. Okay. Now on day 1, lessee has recognized one asset called the right of use asset and the other is called as lease liability. Under subsequent measurement, what we are going to do is we are actually going to see how is this ROU asset being recognized subsequently and how is the lease liability being recognized subsequently. There were two items of balance sheet that were recognized on day 1, ROU asset and lease liability. On subsequent measurement or on subsequent recognition, what we are basically going to see is how is this ROU asset going to be measured. All right, how is this ROU asset going to be measured over the lease period of 3 years and how is the lease liability going to be measured over the period of 3 years. That is what we are going to learn under subsequent measurement. All right, so I'm writing down as part A as subsequent measurement of ROU asset, subsequent measurement of ROU asset. Now, ROU asset or right of use asset is as good as like a fixed asset. It's as good as like a fixed asset. All right. So it is depreciated over the lease term. ROU asset is going to be depreciated over the lease term. The question also, in fact, mentioned it that ABC depreciates ROU asset on a straight line basis over the lease term. All right. So we are actually going to depreciate the right of use asset over a period of 3 years. So let us actually calculate the depreciation per annum. the depreciation per annum is going to be equal to rupees 77,364, the whole divided by 3 years, which is the lease term. All right, 3 years is the lease term. 77,364 divided by 3 is going to be equal to rupees 25,788. All right. So every year, we entity ABC is going to charge a depreciation of 25,788. All right. Every year, entity ABC will be charging a depreciation of 25,788. What is the journal entry going to be for this? It will be depreciation debit to right of use asset. It's going to be depreciation debit to right of use asset. Just like in case of a fixed asset, we do depreciation debit to fixed asset. Over here, we are going to do depreciation debit to right of use asset of 25,788. I'm so sorry. I think I wrote 778 here. All right. So every year we're going to reduce the right of use asset by 25,788. Let us actually plot down the ROU asset schedule. All right. I'm plotting down how the value of ROU asset changes from today until the end of third year. I would like to know how the ROU asset is changing from today till the end of third year. So I'm plotting years 1, 2, and 3. I'm then plotting the beginning value of ROU asset, beginning value of ROU asset at each year. And then we have got depreciation, and then we will have closing value of ROU asset. At the beginning of year 1, the value of ROU asset was 77,364. All right, at the beginning of year 1, beginning of year 1 is nothing but day 0. Commencement of lease is the beginning of year 1. We recognized an ROU asset of 77,364. At the end of year 1, we charge a depreciation of 25,788. At the end of year 1, we are charging a depreciation of 25,788. Therefore, the closing value of the ROU asset will be 77K less 26K, which is equal to 51,576. At the end of year 1, when we prepare the balance sheet, the ROU asset is going to appear at 51,576. All right, we recognize the ROU asset on commencement of 77,000. We depreciate it for 1 year, which is equal to 25,000, and the closing value is equal to 51,576. The closing value at the end of year 1 becomes the beginning value for year 2. The closing value at the end of year 1 will become the beginning value for year 2. In year 2 also, we recognize depreciation of the same value, which is equal to 25,788. All right. So I had a beginning value at year 2 of 51,000. I recognize a depreciation of 26,000 and I'm left with 25,788. At the end of second year, when we prepare a balance sheet, we will actually see the right of use asset at 25,788. Now again, the end of year 2 value will become the beginning year 3 value, which is equal to 25,788. Whatever is the ending value for year 2, that will become the beginning value for year 3. And in the third year also, we charge a depreciation of 25,788, and the closing value of the right of use asset at the end of third year will actually be equal to 0. The ROU asset will actually have an ending value of 0 at the end of third year. At the end of third year, it's going to have a value of 0. Now that's also logical because at the end of third year, ABC is going to return the asset back to the lessor. ABC is going to return the asset back to the lessor. When ABC is not even using the asset at the end of third year, when the ABC does not even have the asset with it at the end of third year, it is appropriate for us to show a 0 value against ROU asset. All right. You can show a value only when you're having an asset. All right. At the end of year 1 and year 2, you were actually having the asset and you were using the asset, and therefore you had a value that was being reported on the balance sheet. Whereas at the end of year 3, you do not have the asset because you have now returned the asset back to the lessor, and hence it is logical that we are actually showing a closing value of 0 against the ROU asset. So when the lease term comes to an end, the ROU asset is supposed to have a 0 value. All right. This was with regards to subsequent measurement of ROU asset. All right, this depreciation was being recognized in the income statement at 25,788, and the remaining balance was being reported on the balance sheet as right of use asset. Now, this was with regards to the subsequent measurement of ROU asset, but we also have to see subsequent measurement of the lease liability. All right, we also recognize lease liability on day one, so we are now seeing subsequent measurement of lease liability. If you think of it, lease liability is actually similar to that of a borrowing. All right, right of use asset was similar to that of a fixed asset. Lease liability is similar to that of a borrowing. Remember, the discount rate also that we used was a borrowing rate, right? So lease liability is similar to that of a borrowing. Just like how you recognize interest on borrowings, you also have to recognize interest on lease liability. You also have to recognize interest on lease liability. At what rate are we going to recognize interest? The answer is we will be recognizing interest using 12 percentage. All right, we will be recognizing interest using 12 percentage. What is the interest going to be for year one? The interest for year one will be 77,364 multiplied by 12 percentage. Principal multiplied by interest rate is going to give you the interest amount. Principal multiplied by the interest rate is going to give you the interest amount. All right. So therefore, the interest for year one will be 77,364 multiplied by 12 percentage, and whatever will be the value that is going to be recognized as interest expense in your P&L account. All right. So let's start by plotting down interest expense. Interest expense for year one. Interest expense for year one will be 77,364 multiplied by 12 percentage, which is equal to 9,283. It's equal to 9,284 actually. If I round it off, it's 9,284. What is the journal entry for this interest expense? The journal entry is going to be interest expense debit 9,284. We are going to credit the lease liability. We are basically increasing our liability. All right. We're just like how in case of borrowings, what we do is interest expense to accrued interest, right? Over here, we are doing interest expense to lease liability of 9,284. All right. So the lease liability increases as a result of interest accrual. After this, we are also making a payment of 20,000 at the end of year one. Remember, there is also a cash flow or a payment of 20,000 that is being made at the end of year one. So there will be a journal entry for payment of 20,000 as well. And that journal entry is going to be lease liability debit to bank. That journal entry will be lease liability debit 20,000 to bank 20,000. This is similar to repayment of borrowing. All right. This is being considered like repayment of borrowing. All right. You borrowed some amount of money, you accrued interest on that borrowing, and now you're actually repaying that. And therefore, the journal entry is lease liability debit to bank account. All right, so there are going to be two journal entries with regards to lease. One is recognition of interest expense. The other is recognition of lease liability. Now you started the year with a lease liability of 77,364. You started the year with a lease liability of 77,364. You then added, you increased your lease liability by 9,284, and then you reduced your lease liability by 20,000. Remember, you started your year with 77,364. You then at the end of year one increased your lease liability by 9,284, and you finally decreased your liability by 20,000. So what is the balance that is going to be outstanding at the end of year one? Let us plot a schedule, something similar to right of use asset schedule. Just like how we prepared a right of use asset schedule over here, let's also prepare lease liability schedule so that we are able to track what is the closing lease liability at the end of year one. What is the lease liability at the end of year one? So we'll start with year 1, 2, and 3. We'll have beginning value. We'll have interest at 12 percentage. We'll have payments. And finally, we'll have closing balance. The beginning value was 77,364. I then recognized interest at 9,284. How did I calculate this 9,284? It was 77,000 multiplied by 12 percentage. I then made a payment of 20,000. I'm writing payment in negative because that is going to reduce the lease liability. Lease liability was initially 77,000. 9,284 is going to increase my lease liability. 9,284 is going to increase my lease liability because the journal entry was interest expense debit to lease liability. Payments are going to reduce, and therefore I'm mentioning it in brackets. All right, payments are going to reduce, and that the closing balance will be 77,000 plus 9,284 less 20,000. 77,364 plus 9,284 less 20,000, which is equal to 66,648. All right. So if you prepare a balance sheet at the end of year one, lease liability is going to be represented as 66,648. All right. So at the end of year one, when you prepare a balance sheet, on the asset side, you will have a right of use asset of 51,576, and on the liability side, you will have a liability of 66,648. All right. When you started off, you recognized right of use and lease liability of 77,364. Both of them had a same beginning value. All right, both of them had the same beginning value, but as time passes by, at the end of year one, the ROU asset had a balance of 51,576, whereas lease liability has a closing balance of 66,648. All right, so the ROU asset and lease liability were equal on day one, but as time passed by, they started diverging. ROU asset has got a different value and lease liability has got a different value. Now the ending balance for year one becomes the beginning balance for year two. All right, so the beginning balance for year two is going to be 66,648. Whatever is the ending balance for year one, that becomes the beginning value for year two. Now in year two also, we're again going to calculate interest. We're again going to calculate interest for year two also. But interest for year two is not going to be 9,284 because your principal has now reduced. Your principal is now 66,648. The principal is now 66,648, and therefore you are going to recognize 12% interest at this on this principal. We will be recognizing 12 percentage on 66,648. All right, so I'm just writing it down. Interest will be recognized as 66,648 multiplied by 12 percentage. That is going to be equal to 7,998. All right, what is the journal entry going to be for the 7,998? It's going to be interest expense debit to lease liability. Interest expense debit to lease liability of 7,998. And then we reduce payments of 30,000. We're going to reduce payments of 30,000, and that is going to give us a closing balance of 44,646. It's 44,646. So at the end of year two, lease liability is going to be 44,646 and ROU would have been 25,788. All right. So ROU asset and lease liability are not equal at the end of year two either. Remember, what is going into the P&L account is this depreciation in case of ROU asset, and we are also recognizing interest expense in P&L account. What is going to P&L account in each year is the depreciation and the interest. Depreciation on ROU and interest on lease liability. Both of them are being recognized in the P&L account. Now the closing balance for year two will become the beginning balance for year three, and I'm plotting down 44,646 as the beginning value for year three. Now, interest for year three will be recognized based on the principal outstanding at year three. Principal outstanding at year three was 44,646, and therefore 12% interest will be recognized on 44,646. It's going to be 44,646 multiplied by 12 percentage, which is equal to 5,357. It's 5,357. I then have a payment of 50,000 that I'm making. In the third year, we're making a payment of 50,000. And if you take the sum total of beginning value plus the interest and less payment, we are going to have an ending value of 3 rupees. We're having an ending value of 3 rupees. In fact, this ending value is actually supposed to be equal to 0. This ending value should actually be equal to nil. Why is it supposed to be equal to nil? At the end of third year, you do not have any liability left. All right. Are you required to make any payments in future? The answer is no. Therefore, at the end of third year, if you're not obligated to make any payments in future, then your liability should obviously reflect zero value. Your liability should basically reflect a zero value, and hence this is ideally supposed to be nil. And what we are going to do is, instead of recognizing interest expense of 5,357, I will be recognizing 5,354, which is a rounded number. Instead of recognizing 5357, I will recognize 5354 in such a way that the closing balance is going to be equal to 0. Interest expense for year 3, I will not do 5357. I'm going to round it off to 5354 so that the closing balance is actually equal to 0. All right. So at the beginning of year 3, we had a lease liability of 44,646. I recognize interest at 12% on the beginning value, and then I've got payments which I deduct from the lease liability, and the closing balance of the lease liability is 0. All right. So at the end of third year, both the right of use asset and the lease liability go down to 0. At the end of third year, I do not have the asset with me. I return the asset back to the lessor. Therefore, ROU asset is rightly supposed to be reflected at 0 value. Same way, at the end of third year, do I have an obligation to pay to the lessor? The answer is no. All my obligations have been paid out. I had 3 years of payments. I've made all the 3 years of payments. Therefore, there cannot be a closing balance left at the end of third year. Therefore, at the end of third year, both ROU and lease liability will go down to 0. Both ROU and lease liability are going to go down to 0. All right. Now we've seen the subsequent measurement of ROU asset and subsequent measurement of lease liability. With that, we are actually done with the question. But I would like to actually show you something. All right. Let us plot down the depreciation expense and interest expense in each year. Depreciation and interest expense that we are recognizing in each year. Depreciation is constant at 25,788. Depreciation was equal for all the 3 years at 25,788. Now, interest is actually fluctuating. In the year 1, we had interest of 9,284. Year 2, we had interest of 7,998. And in year 3, we have interest of 5,354. All right, the interest is fluctuating. Why is the interest fluctuating? Reason being, we're calculating interest on the outstanding principal or outstanding lease liability. Outstanding lease liability is changing once we are making payments. Every time we make payments, outstanding liability is changing, and hence interest is actually reducing because we are repaying the borrowing, because we are making payments. Our interest expense is actually reducing because as we repay the borrowings, interest will automatically reduce. All right. Therefore, we see a decreasing trend in interest. Let us actually calculate the total for year 1. Total for year 1 is 25,788 plus 9,284, which is equal to 35,072. For year 2, it's 25,788 plus 7,998, which is equal to 33,786. And for year 3, it is 25,788 plus 5,354, which is equal to 31,142. The total of this is going to be equal to 1 lakh rupees. The total is equal to 1 lakh rupees. Now, if you carefully think of it, the payments that you have made to the lessor are actually 20,000 plus 30,000 plus 50,000. The total payments that you're making to the lessor is also rupees 1 lakh. The total payments being made to the lessor are also equal to 1 lakh rupees. Right? What is actually happening through Ind AS 116 is whatever amount you're actually paying to the lessor, that should be your expense. Remember, logically, if ABC is making a payment of 1 lakh to a lessor, the 1 lakh should be recognized in P&L over a period of 3 years. All right, because 1 lakh is the total payment for 3 years. That 1 lakh should be recognized in P&L over a period of 3 years. What Ind AS 116 is doing is it is recognizing this 1 lakh as an expense over a period of 3 years, but it is not doing it equally over a period of 3 years. It's recognizing 35,000 in first year, 33,000 in second year, and 31,000 in the last year. All right. What Ind AS 116 is ensuring is whatever you make payment, that is being recognized in your P&L, but it is not being recognized on an equal basis or anything. What it is doing is it is requiring us to recognize a right of use asset and lease liability on day one and depreciate that right of use asset and recognize interest on that lease liability. And the total is actually not equal. The total is not equal. In fact, the expense in year one is greater than the expense in year two, and that is greater than the expense in year three. All right, year one is greater than year two and that is greater than year three. The reason that is happening is because of interest expense. Interest expense is higher in year one and then lower in year three. Interest expense is actually reducing from year one to year two to year three, and that is the reason the total expense is also reducing. Depreciation is actually constant, interest expense is reducing, and therefore your total is also reducing year on year basis. All right, so what Ind AS 116 is actually doing is it is ensuring that whatever you make as a payment to the lessor, that is recognized as an expense, but it is not recognized as an expense on an equal basis. We are recognizing depreciation and interest, both of which are calculated separately, and the sum total is ultimately going to the P&L account. All right, usually the expense in year one will be the highest because the interest is going to be the highest in year one. As you keep making lease payments, your borrowing or lease liability is going to reduce, and therefore your interest will reduce. When your interest reduces, your total expense will also reduce. All right, always what you need to ensure is that the total payments made should actually be equal to the sum total of depreciation plus interest. The total payments that are being made by the lessee to the lessor should actually be equal to the depreciation plus interest that is being recognized across all the 3 years. Remember, it won't match on a year-on-year basis. For example, in the first year, you're making a payment of 20,000, but you're recognizing an expense of 35,000. All right, so whatever payment you make in year one will not match with the expense of year one. Payment of year one will not match with the expense of year one, but payment for all the 3 years put together will match the expense of all the 3 years put together. All right, so cumulative payment should be equal to cumulative expense. This was point number one that I wanted to communicate. Another point is I said that lease liability is similar to that of borrowing. Lease liability is similar to borrowing, and therefore I said that we have to recognize interest expense on such borrowings. While that is also true, there is another way to also look at interest that we are recognizing. The interest that we are recognizing, if you think of it, the lease liability is measured in present value terms. All right, so 77,364 is basically on the date of commencement of lease. On day zero, the value of lease liability was 77,364, which is the present value of the payments that are expected to be made. Now, as time passes by, don't you think this lease liability, which was measured in PV terms, should actually be compounded so that it moves along with time? All right, you cannot keep lease liability constant at 77,000 when time is passing, because 77,000 was in present value terms on day zero. At the end of year one, if time has passed by and you're now standing at the end of year one, this lease liability of 77,000 has to be compounded, and it has to be brought into terms at the end of year one. Lease liability of 77K was based on day zero. If you are now standing at the end of year one, this lease liability should be compounded so that it is now coming to PV terms. All right. Otherwise, it would have been in PV terms on day zero. It should now come to PV terms at the end of year one. And to do that compounding is being done through interest. And that compounding is basically being done through recognition of interest. All right. Compounding basically increases the value. And therefore, what we are doing is increasing the lease liability. All right, so other way to look at interest expense. The first way was basically that interest expense is similar to borrowings. Another way to look at interest expense is that this interest expense is basically the impact of compounding the lease liability. We're standing at day zero. Now we are standing at end of year one. Therefore, this lease liability should be compounded into terms of end of year one. It should be brought to the terms of end of year one, and that is being done through recognition of interest. How are we doing it? We're basically calculating 77,000 multiplied by 12% is equal to the effect of compounding. All right, the effect of compounding is also referred to as unwinding of lease liability. All right, the compounding process is also referred to as unwinding of lease liability. So there are two ways of looking at this interest expense. One is that it is actually lease liability is similar to borrowing, therefore you're recognizing interest on that borrowing. The other way to look at it is the lease liability is in present value terms, therefore as time passes by you are supposed to compound it, and that compounding is being done through recognition of interest expense. All right, so this is the other way to look at interest expense. Now let's quickly look at the institute solution. On the commencement date, all right, we are recognizing 77,364 of ROU asset and lease liability. We have then prepared lease liability schedule where they have recognized interest expense of 9,000, 7,900 and 5,354. And over here also they've mentioned that we have basically done an approximation. We have done an approximation which we also actually did. ROU asset, we have depreciation of 25,000 equal every year, and the closing balance becomes zero for both ROU asset and lease liability schedule. All right, they've plotted the journal entries as well. ROU debit to lease liability, interest expense debit to lease liability of 9,200, and then we've got depreciation to ROU asset and lease liability to bank of 20,000. All right, so and then they have also plotted the total periodic expense. We also plotted the total periodic expense of 35,000, 33,000 and 31,000 for year 1, year 2 and year 3, and these are the value of ROU asset and lease liability at the end of year 1, end of year 2 and end of year 3. Initially they were equal. Initially ROU asset and lease liability are equal, but as time passes by their values actually diverge. All right, but at the end of third year both ROU asset and lease liability are basically going down to zero. All right, so with that we are done with illustration number 30.